Something doesn't add up, and if you've even casually looked at the housing market recently, you've probably felt it. Right now, fewer people are buying homes in America than at almost any point in the last 30 years, and yet home prices are still sitting near all-time highs. That should not be happening. In any normal market, when demand drops, prices follow. That's basic economics. But that's not what we're seeing. What we're seeing instead is a market where people can't afford to buy and prices still refuse to come down. It's like watching a store with no customers keep raising prices and somehow staying open. And the uncomfortable truth is, this isn't random and it isn't temporary. This is the result of a system that quietly changed over the last few years, and most people didn't even notice it happening. Which means if you're thinking about buying a home today, you're not just making a financial decision, you're stepping into a completely different system than the one people relied on even 5 years ago. And if you don't understand how that system changed, it's very easy to make a decision that feels fine today, but turns into regret later. So instead of guessing, let's break this down properly using the actual mechanics behind what's happening. If you look at the numbers today, the shift becomes obvious. The median home price in the United States is now hovering around $400,000, while just a few years ago it was closer to $270,000. That's not a gradual increase driven by slow growth. That's a sharp jump in a very short time. Now combine that with mortgage rates. In 2021, you could lock in a 30-year mortgage for under 3%. Today, that same loan sits closer to 6.5 or even 7%. The house hasn't changed, the structure hasn't improved, and the neighborhood hasn't magically become better. But the cost of owning that same house has increased dramatically. So naturally, fewer people can afford to buy. And when fewer people can afford something, demand is supposed to drop and eventually prices are supposed to follow. Demand did drop, prices didn't. That disconnect is where the entire story begins. To understand why this is happening, you have to go back to 2020. When the world shut down, the economy faced an extreme level of uncertainty, and the Federal Reserve stepped in to stabilize things. Interest rates were cut to near zero, and massive amounts of liquidity were injected into the system. In simple terms, money became incredibly cheap to borrow. And when borrowing becomes cheap, people don't just borrow, they stretch their limits. Millions of Americans suddenly realized they could afford more house for the same monthly payment. Homes that once felt out of reach suddenly looked attainable. At the same time, something deeper changed. The role of a home itself shifted. It no longer was just a place you returned to at the end of the day. It became your office, your workspace, your gym, your classroom, and in many ways, your entire daily environment. That shift changed expectations. People didn't just want homes anymore, they needed better ones. More space, more comfort, more flexibility. So demand didn't just increase, it surged all at once. But supply didn't keep up. The United States had already been underbuilding homes for years after the 2008 crisis. Builders had slowed down, regulations made construction harder, and affordable housing became less profitable to produce. So when demand spiked, there simply weren't enough homes available. That imbalance pushed prices up quickly. Then came 2022, and everything reversed. Inflation surged, and the Federal Reserve had to act again, this time in the opposite direction. Interest rates were raised aggressively, one of the fastest increases in decades. Mortgage rates followed almost immediately, and just like that, the math changed again. The same house that felt affordable a year earlier suddenly became expensive. Not because the house improved, not because incomes increased, but because the cost of borrowing money went up. For many people, the monthly payment jumped from manageable to uncomfortable almost overnight. Buyers stepped back, fewer offers came in, transactions slowed, the market lost momentum. At this point, everything looked like it was lining up for prices to fall, but instead of dropping, prices held steady. And the reason for that shift isn't about buyers, it's about sellers. Millions of homeowners locked in mortgage rates during 2020 and 2021 that are historically low. These are rates that may not return for a long time, if ever. And those low rates created a powerful incentive to stay put.
Because now, selling your home isn't just about moving, it's about giving up one of the best financial positions you're likely to ever have. If you sell and try to buy another home today, you're replacing a low-cost loan with a much more expensive one.
That difference can mean hundreds, sometimes over $1,000 more every month for a similar home. So even if someone wants to move, the math often tells them not to. And when millions of people make that same decision, something unusual happens. They stop listing their homes. Inventory stays low, and when supply drops along with demand, prices don't crash. The market doesn't correct the way people expect. It simply slows down and becomes stuck. To see what this looks like on a personal level, think about someone like Daniel. He's in his mid-30s, has a stable job, earns a solid income, and has done everything right financially. He's saved consistently, avoided unnecessary debt, and built a strong credit profile. For years, he assumed that eventually he would be able to buy a home. That's what the system promised. But when he actually looks at the numbers today, the situation feels completely different. The homes he was targeting a few years ago are now significantly more expensive. Mortgage rates are higher, and when he adds up the full cost of ownership, including taxes, insurance, and maintenance, the monthly expense takes up a much larger portion of his income than expected. Not because he made poor decisions, but because the rules changed, and that's the part most people struggle to see. This isn't just about personal discipline, it's about a structural shift that has made the same goal harder to reach. There are millions of people like him, financially responsible, stable, prepared, and still unable to comfortably enter the market. When people see a situation like this, the natural question is whether this is another 2008, but the reality is very different. Back then, the problem was weak lending standards. Many people were taking on loans they couldn't realistically afford, and when prices stopped rising, the system collapsed. Today, lending standards are much tighter. Borrowers are generally more qualified, and most homeowners have significant equity in their homes. So instead of a fragile system that's about to break, what we have now is a system that's constrained. It's not collapsing, it's just not moving. And that's why it feels so frustrating. There's no dramatic crash, no obvious reset, just a slow, stuck market that continues to absorb more of people's income over time. Looking ahead, there isn't a simple solution. If mortgage rates drop significantly, more buyers will return to the market, but supply won't increase overnight, and that could push prices higher again in the short term. On the other hand, if rates stay elevated, the market may continue moving slowly, with affordability improving gradually as incomes rise. But that kind of adjustment takes years, not months. The most realistic outcome is a slow correction, where the market gradually finds balance again. Not a crash, not a sudden recovery, but a long period of adjustment. So what does this mean for you? It means your decision should be based on your own numbers, not the market's narrative. If buying a home fits comfortably within your budget and you plan to stay long-term, it can still make sense. But if you're stretching your finances just to get into the market, that's where risk begins to build quietly. Because in an expensive environment, even small financial stress points can turn into bigger problems. The biggest mistake right now isn't waiting, it's overcommitting. This also connects to something deeper that often gets overlooked. Many people assume that as long as their salary increases, they'll eventually catch up to rising costs. But in reality, systems like housing often move faster than individual income growth. You might be earning more than you were a few years ago, but if housing costs have increased even faster, your situation hasn't improved. It may have actually become more difficult. We explored this idea in detail in our previous video on the salary trap, where we break down how earning more doesn't always translate into building real wealth. If you haven't watched that yet, it's worth checking out after this. The housing market today isn't just expensive, it's structurally different. And if it feels confusing or frustrating, that's because the underlying system has changed in ways that aren't immediately obvious. But once you understand those mechanics, you stop reacting emotionally and start making decisions based on what actually works for you. If this breakdown hit differently and you want to keep understanding money the way they never taught you in school, please like the video so that it reaches the right audience. And subscribe to Decoded. We decode the psychology, the systems, and the real mechanics behind wealth, so you stop reacting to your finances and start understanding them, one video at a time. See you in the next one.